What a week we've got going on. And this overall line of thinking that higher yields are, in fact, bad for long-term growth names. You say, though, history might have a quibble with that.
Yeah, so I mean, I think, first of all, looking at the market this week, we're 2 days into the week, and tech has sold off sharply. But over the last week, tech is performing in line with the S&P 500, even including those 2 days. Look back at last week, tech outperformed the S&P 500 by 2 full percentage points. So there was a big bout of outperformance last week, and I think some of this is coming back, reversion to the mean. Semis were up more than 1%, 6 weeks in a row. In the history of the stocks, that's only happened 5 or 6 other times. So it's been a very big run. But so now getting back to your point about rates and tech stocks, we always hear that when rates go up, it's like kryptonite for the technology sector. But if you look back historically in the post-financial crisis period, what we've seen is that tech stocks have actually done very well during rising rate environments and even outperformed the S&P 500. So there's been about 15 periods where we've seen the yield on the 10-year Treasury rising by 20% or more, and then 15 periods where it's fallen by 15% or more. All 15 of those periods where rates were rising on the 10-year, tech was higher in every one of those periods, 15 out of 15. The S&P was also higher 14 out of 15 times, but overall, tech saw actually a little bit of outperformance versus underperformance.
Right. Not to say that, all right, so we understand that it's possible for tech to rise in that environment, but is it the actual sweet spot? Does that dynamic change?
Well, no, I think what you're seeing is like what we're seeing this week is we've seen a quick spike in rates, and we've seen a fast move. And when you see those fast moves in the initial stages of these legs higher in rates, it causes some dislocations that we see and causes sell-offs. But then overall, you tend to see the sector get back on track. And I think if you're going to start betting against the technology sector here on the premise of higher rates, you're really going against the grain, and you have to have a good reason for why this time is different versus other times.